Hi, and welcome to the Downtown Pittsburgh IBD Meetup. This is the October 2016 presentation. My name is Eric Rossi. I'm a co-organizer for this meetup group. And if you found this video on YouTube, you can use the link shown here to go to our meetup group page, and you could join and become a member of our meetup group, and I'll talk about some of the benefits of that later in the video. Introduction. So our mission statement is to educate individual investors about the CAN-SLIM investing strategy, which was developed by Bill O'Neill and is now managed by Investors Business Daily. So this means identifying the best educational material available. And this presentation is for educational purposes only. I'm not making any recommendations to buy or sell securities. Investing in stocks does carry risk, and you can lose your capital. I'm a non-professional volunteer investor. Investors Business Daily, IBD, and CAN-SLIM are registered trademarks of Investors Business Daily, Inc. MarketSmith is a registered trademark of MarketSmith, Inc. And Meetup is a registered trademark of Meetup, Inc. And prerequisite, this video assumes that the viewer is familiar with the CAN-SLIM investing strategy developed by Investors Business Daily. At a minimum, viewers should read the book shown here, How to Make Money in Stocks by William J. O'Neill. And if you haven't read this, you can certainly watch the video and hopefully it'll be beneficial to you, but it'll be much more beneficial if you're familiar with the basics of this system. Topics for this month. First, we'll go through the market dashboard as always. Then we'll go through, last month started a CAN-SLIM Back to Basics review. So last month we covered the C for current earnings growth. This month we'll cover the A for annual earnings growth. Then we'll talk about a concept called pyramiding when buying stocks. Then we'll do a market analysis, and we'll look at some recent trades, and then we'll conclude. So at the time that I made this video, we're in an uptrend under pressure. The uptrend health, as I call it, is basically how old is the uptrend, if we're still in one. And we are in one, and it is quite old. It's been going on since the end of June. So one of the longest running times when I've seen IBD keep the market pulse in an uptrend or uptrend under pressure and not go into correction at all during that time. So this uptrend is long in the tooth, as they say, meaning we're kind of overdue for a correction of some sort. Distribution days, which IBD keeps track of these, and these are high volume days of distribution in the major indices. So we've got 7 for the S&P and 8 for the NASDAQ. That's a pretty high count. If it goes much higher than that, IBD typically puts the market pulse into a market in correction. And then Fed activity. The Fed raised rates last December, and they're expected to do the same this December. So given all these, we get 2 yellows and 2 reds on this screen. So not too good there, no greens. Next screen, we've got all reds. The S&P 500 is below the 50-day moving average. It's up for the year, but just barely. And the accumulation distribution rating assigned by IBD is a D-, which is almost the worst it can get. And you can see the NASDAQ is in the same situation, barely up for the year. The accumulation distribution rating for the NASDAQ is an E, which is the worst possible. And then the IBD 50, which is an index of top growth stocks. It's a proprietary index maintained by IBD. That index is below the 10-week moving average. It's trading right at the 40-week moving average, and it's actually down for the year. So this shows you that growth stocks are slightly underperforming the indices for the year, which is not a good sign. So all 3 of those get a red. And then these are unchanged from last month as far as our last bull market. We're currently still in a bull market, arguably transitioning to a bear market. It's too early to tell. And this bull market started in March 2009, so it's been running for a very long time in terms of historical bull market lengths. This is one of the longest ones in history. So we get a yellow there. In other words, caution is warranted right now because this uptrend's been going on for so long. We've been in this bull market for so long. And the last bear market ended in February 2009 after the financial crisis. So again, we've been going a long time without a bear market. Historically, we're overdue for a major correction here. And intermediate corrections, which are smaller corrections that are not bear markets. I use the NASDAQ here. That counts at 9. It's going to go to 10 pretty soon if we keep pulling back much more. So we get a yellow here and 2 reds. So overall on the market dashboard, we've got yellows and reds, and we've got more reds, I think, than anything else. So it's showing that this really is not a good market environment right now to be buying growth stocks and to be deploying the CanSlim investing strategy. Certainly other strategies could be more appropriate right now. Maybe day trading is working better, but we're just talking CanSlim investing here. And now is not a great environment to be buying growth stocks. Next topic is CanSlim. So this is kind of a back to basics here. CanSlim is an acronym that was developed by William J. O'Neill, which described his methodology of investing in growth stocks. And here I list out what each letter stands for. And this month we're going to talk about the A, which stands for annual earnings growth. And this material comes from Chapter 4 of How to Make Money in Stocks, which is Bill O'Neill's main book that I showed earlier in the video. So EPS is earnings per share, and companies report earnings per share on a quarterly basis, and then they also report the results for the year. And earnings per share is the company's total profits divided by the number of shares outstanding. Now that's different than the EPS rating in Investor's Business Daily. That EPS rating is a proprietary measure of a company's overall earnings growth, and it takes into account quarterly and annual earnings growth. So you want to select stocks with a large percentage increase, 25% or more, in annual earnings growth over the past 3 years. And the larger the percentage increase, the better. And the reason that we want to look at annual earnings growth, in addition to looking at quarterly earnings growth, which I talked about last month, is that quarterly earnings growth can be an anomaly. It could just be a good quarter, or it could just be a couple good quarters. But when you see quarterly earnings growth that's very strong, and then you see annual earnings growth that's very strong, it shows that the quarterly earnings growth they're not just anomalies, and that the overall earnings growth is more sustainable. So it means that a company, for example, a retail company might have a really good quarter, the last quarter of the year, because of Christmas time and people buying gifts for everyone. So you don't just want to give too much focus on that, because for the year, the company might actually not be showing earnings growth for the year, even though they had a really good quarter. You also want to see consistent annual earnings growth. That's better than erratic annual earnings growth. And what I mean by that is that if a company's up 25% earnings growth one year, the next year it's up 10%, the next year it's up 50%, the next year it's up, let's say 15%, you'd rather see a company that's reporting, that's doing, let's say, 20% one year, 25 the next year, 30 the next year, with numbers that are closer together and more consistent. And ROE is return on equity, and this is a measure of a company's efficiency. I'm not 100% sure why Bill O'Neill put this topic in the annual earnings growth chapter of his book, but he did. And the bottom line with ROE is you can get this information through IBD, and I'm going to show you how to find all this. You want to look for 17% or higher, and again, higher is better. Higher means that the company is driving more of their sales money towards directly to earnings, to profits. Okay, so where can you find all this information as far as annual earnings growth? Well, there's a few places. There's the IBD mini charts, there's the stock checkup on investors.com, and if you're a MarketSmith subscriber, you can find it there. So I'm going to show you how to find it in each of these areas. Okay, so finding the A in the IBD mini charts. So if you go to these IBD mini charts, you can see this is the EPS rating right here. And that's the proprietary rating of earnings per share growth for a stock. So it's a number 1 through 99, and 95 here means that this company, Gigamon, their earnings growth is better than 95% of the companies out there. So that's really good. And remember, this EPS number takes into account annual earnings growth and quarterly earnings growth. So this number here, this EPS number, you get really the C and the A in CanSlim in this number. Okay, but we can't really derive annual earnings growth from this directly. Okay, but on the mini charts here, you can get annual EPS growth right here, plus 35%. So this tells you what the annual earnings growth has been in recent years. And I believe this is an average of the past 3 years. So that's how you find the A in on the IBD mini charts. Okay, next is the IBD stock checkup. So if you go to investors.com, you can look up, it's called the stock checkup if you're a subscriber on any stock. And it gives you just a list of parameters here, and then a value for each parameter, and then they give you a green, red, or yellow. So it's a nice, you can get a nice quick visual of how the company is looking overall. So like I mentioned, like this is Gigamon again, EPS rating here, this includes the C and the A, but you can't tell, you can't really tell what the annual earnings growth is from this. Under the stock checkup, you get current earnings, which we covered last month, and then you get annual earnings down here. So here's your 3-year EPS growth rate, which I believe is the same thing that's on the mini chart that we saw on the previous slide. So 56% is really good. And then consecutive years of annual EPS growth is 1, meaning that they're only showing 1 year here of EPS growth on an annual basis. This is a relatively new company, so the stock was not doing very well for a long time, and it's really taken off this year. So that's a little bit of the reason there. But if you looked at a company like Priceline or Chipotle when they were making their big runs, you would have seen more than likely several years here because it was more sustainable earnings growth over a longer period. And remember, this EPS growth rate, the higher the better. Same thing with the quarterly earnings growth rates up here. At least 25% is what Bill O'Neill recommends, but 56% is better than 25%. And then here you get EPS estimate change for the current year. So the estimate for the current year is 58% increase over the prior year. Okay, and lastly, for the A in CanSlim, if you want to find the annual earnings growth in MarketSmith, when you look at a stock on a daily or weekly chart, you get here a listing of the annual earnings growth for an annual basis for quite a number of years. You can see, like this one goes back about 9 years, and then you get the estimate for. This is an estimate here for the current year, an estimate for the next year. And then this arrow means that the estimates were recently revised higher. If the arrow is pointing down, a red arrow, that means the estimates were lowered. So you can see here 12 cents a share, 33 cents, 37, 53. So we had some acceleration here. Then we dropped to 12 cents, 80 cents. So now we're increasing again. So that's a good sign. And you also get the EPS growth rate. You can get it here in MarketSmith. And then one thing MarketSmith provides that I haven't seen on IBD and the stock checkup is this called earnings stability. And what this is a measure of how consistent the company's earnings growth is. So if the earnings growth is very erratic, then you're going to get a high number, you're going to get a high number here. If the earnings growth is more consistent, like I mentioned, Priceline, Chipotle, companies like that that were doing really consistently well for a long period, a number of years, you would see a lower number here. This particular one, like EPS rating here, higher is better. On earning stability, higher is worse. So you want a lower number here. So 70 means this company their earnings growth is more erratic than 70% of other companies. Okay, and if you don't have Bill O'Neill's book that I mentioned, I'd go buy it. It's only like 20 bucks. It'll be very worth it for you. But if you don't want to do that, you can also go to investors.com and go to on the How to Invest tab here, and then click on the CanSlim investing system, and you'll get all the letters of CanSlim here. You can just click on the A. It'll take you right to all the information about annual earnings growth. Next topic is pyramiding. So pyramiding is the strategy of basically getting into a stock gradually with multiple purchases instead of buying the entire position at once. Okay, this strategy reduces risk because you would only add to your initial buy, which some people call it a pilot buy or a test buy. You will only add to that if if the stock rises in price. So you only reward the buy with more buys if the stock's doing well. If not, you don't put any more money at risk. Risk is also reduced because if the stock price declines, then you only take a loss on part of a full position. So if you made your first purchase, the stock starts to decline, hits your stop loss, you're only taking a loss on that first purchase instead of on a full position. Most pyramiding strategies utilize 2 to 3 purchases to build a full position. I like 2 personally. I do a 50% of the position once, and then I'll add another 50% if it meets the criteria I'm looking at. And the first purchase, which a lot of people refer to these as B1, would be your first purchase. The first purchase is the largest, and then the remaining purchases would get progressively smaller as the stock price rises. So I'll show an example of this on the next slide, but B1 is our initial buy, and B2 would be our second buy, B3 would be the third buy, etc. So if you were going to do pyramiding with 3 buys, you would have a B1, a B2, and a B3 to get a full position. And if you were going to do like I do with 2 buys, you would have a B1 and a B2 only. And you can have more than 3. You can really have as many as you want. And you can either pyramid based on percent increases in the stock, or you can do it based on the price action. So let's talk about an example here. Let's say you want to open a $10,000 position in Facebook. Well, without pyramiding, you would buy $1,000 worth of stock in $10,000 worth of stock in one purchase. That's it, easy, right? But with pyramiding, like I said, it does reduce your risk and it can improve your performance. So with pyramiding, let's say we do a B1 and a B2, you can make 2 equal purchases of $5,000 each, and they would be at different price levels based on your pyramiding strategy for that stock. And I'll show some specific strategies when we go into MarketSmith here. So if you did pyramiding with a B1, B2, and B3, you can make 3 separate purchases, and that might look something like this. The B1's the biggest one at $5,000, that's half your position. The B2 is $3,000, which is 30% of your position, and the B3 is 20% of your position. So notice how the purchases get progressively smaller as the stock price increases. And you should plan your pyramiding strategy before buying a stock, and it's okay to have different strategies for different stocks. And I'll talk about why that's the case here. Okay, I'm going to switch over to MarketSmith now, and we'll talk about some specific examples of pyramiding. Then we'll look at the market analysis, and then we'll talk about some recent trades. Okay, here we are in MarketSmith, and let's talk about pyramiding some more. Let's talk about some specific examples here. So this is Gigamon. This has been a big winner for the year. And let's go back and look at this cup with handle base here, which launched the way for this big move that it's made, up 60% now from there. So let's say that you don't necessarily want to buy your full position. You don't want to have to necessarily wait till right here, where the stock breaks out of this cup with handle, and it had a really nice breakout. But rather than buying, if we want to buy, let's say, $10,000 worth of this, we can do better than waiting right here to buy $10,000 worth. Now, IBD recommends waiting for the breakout and starting your B1 right here at the ideal buy point. So the ideal buy point on this is 34.14, which is right about there. So IBD would say, hey, make your first buy right there. Maybe you buy 50% of your position, $5,000. And then when the stock goes up a couple percent from there, but no more than 5% from the buy point, you would make the rest of your purchase. Okay? That's one way to do pyramiding. You could also buy right at the ideal buy point, right at 34.14. You could buy, let's say, you could buy $5,000 worth, and then when the stock goes up 2% from there, you could buy another 3,000, and then when it goes up another 2%, you could buy 2,000, and that would give you your full $10,000 position. Okay, IBD says you can buy it from the ideal buy point up to 5% above that level. So whatever's 5% above 34.14, you can buy it anywhere in that range. Now, that's IBD, how they teach how to do pyramiding. You can do better than that, and one way you could do better than that is you can use some earlier buy points. In this particular base, for example, this base forms, about half of it forms under this red line, which is the 50-day moving average. You could say, if this is on your watch list throughout here, you could say, okay, I'm going to actually make my first buy when this thing breaks through the 50-day moving average, which would be right here. And that would get you in quite a bit earlier. Now, there's no guarantee it's going to work out like this and keep going up, but you could make that your B1, let's say, and then you could make your B2 when the actual breakout is. Okay? You could also, I'm going to zoom in, I'm going to go back to the day of the breakout here. Okay, so this is what this cup with handle looked like on the day of the breakout. So like I said, IBD says from this pivot point you can go 5% above that. So anywhere in this blue range in MarketSmith is buyable. Well, I was saying you could actually, let's say you had been watching this and you said, okay, it looks like it's forming a base. I don't know what kind of base it's going to form or if it's going to work or any of that. But you could make your initial buy, let's say, when it breaks through a key moving average, like the 50-day here. Or you could use, in this case, I used the sloping trend line here, and you could get in a little bit earlier. You could buy it when it breaks the sloping trend line, which would be a little bit before the pivot point here. So you could make your B1 right here. You can make your B2 like right here. Okay, and that's getting you, both of those are getting you in earlier than waiting for this breakout from this pivot point. Okay, so that's one example there of doing pyramiding. Let me show another example. Look at Dave & Buster's here. So this stock was forming a, it looked like it was forming a double bottom. And I'm actually going to go back. Let me go back to what it looked like this day. Because I was watching the stock and really trying to get in early. It ended up, you saw on the chart there, really hasn't done anything since then. But so this stock here, when I was watching this, and when I saw it undercut this 40.95 right here, and I saw it go underneath the 200-day, I was thinking, okay, I want to. If I'm not interested in this stock because it was one of the few that was forming a base, and it had good fundamentals, and it still does. So I was looking at it down here saying, okay, if this breaks above the 200-day, I could use that as my initial buy, my B1. Or I could say when it comes back above this 40.95 level, I use that as my B1. And then I could use the 50-day moving average as my B2. So if it breaks through that, that could be my B2. Now you could also use, like here, a sloping trend line, and you could say, okay, maybe I'm going to make a B1 here, a B2 here, and a B3 here, and get you into your full position. Now again, IBD standard, their standard base buying process would be wait for the breakout up here, and then buy 0 to 5% above here. Okay? So within that 5%, you can do whatever you want. You can have, if you want to have two buys, 3 buys, 5, whatever. It's up to you. I'm just showing another way here that you can think about this as far as getting in earlier and how to look at this before you buy it and say, okay, what's my strategy for entering into a full position? When am I going to buy it? How much am I going to buy at each stage? Okay, let's look at one more. Let's look at Acacia was a big winner for the year, although you can see it's not so much of a big winner right now. Let's go back to the breakout day on this one. Okay, so this is what this stock looked like on the initial breakout from the IPO base, which ended up failing. But let's say you were looking at this in here, and IPO bases usually want to see at least 7 days in the base. So let's say you have this stock on your watch list, and you're watching it pull back here, and you're looking at it through here. If you were thinking about buying the stock, you could, as far as building a full position, you could start building your position, start your B1, let's say when it retakes the 10-day line after here. So you could say, oh, okay, it's retaking the 10-day moving average. I'm going to make that my B1. Your B2 could be when it breaks through this early resistance point here in this base, which is 41.20. So you'd be getting your B2 right here. And you can make your B3 when it actually breaks out of the base up here at 43.10. So you're making your biggest buy at the lowest price, your second biggest buy at the next highest price, and your smallest buy at the highest price. And that's what is meant by pyramiding, how it helps you control your risk and lower your risk. Because if you did buy it here, let's say, and then the stock tanked the next day, well, you only bought part of a full position. So if 10,000 is your full position, maybe you put 5,000 in, you're only taking a loss on 5,000 as opposed to 10,000. The other nice thing about this is that, let's say that the stock breaks out here like Acacia did, and now it fails. It pulls back and it fails, just like this happened here. Okay. Well, at this point, if we use the strategy I said earlier, B1, B2, B3, right here you could sell, you would probably have to sell this B3 because it would be at a pretty big loss. It might have hit your stop loss. Whereas your B2 is still okay. It's about break even. You might sell it. It's up to you. But you still have your first buy here that's still up. So this is one nice thing about building into a position gradually as opposed to buying the whole thing all at once. Okay, so those are some specific examples of how to think, how you might use pyramiding to build a full position in a stock. Okay, let's go to the market analysis. We'll start with the monthly on the NASDAQ. So as I said in all these videos, we had this really long uptrend here for a long time, and I drew a line here showing the prior highs from March 2000, the technology boom. And you can see here we're hovering right around, we were hovering right around new highs right here, all-time highs. And you can see that for the month of October, we finished at the bottom, we finished near the bottom of the monthly range, and monthly volume was lower than what it's been recently. So it was a down month, but it's not too ominous, and we're still just kind of hovering in this range here. We're right between here and this 4209. We're in this is called range bound market, where it's really not doing a whole lot. Stocks aren't really doing a whole lot either. So here's the weekly chart, and same thing. I drew a line here around the highs we had hit back here in July of 2015. We did break above those very briefly here, and now we're pulling back. But the last month, you can see we had 3 down weeks, 1 up week. Volume wasn't particularly high, so it was October was kind of a lackluster month. And if we go here, we ended October right around here. So since then, we know that we're getting close to the election here, and there's a lot of angst in the market. So we're selling off here, but and volume is picking up. You can see all these red bars, and see how their volume's trending upwards here as the market comes down. And a lot of these days are finishing at the bottom. You can see how these are finishing at the bottom of the range, except for this day here. So the market's looking pretty weak right now. It broke through this prior low here around 5100. So some things to look for is the 5,000 mark is going to be a big level. We'll be looking for support. So you might see it bounce off the 5,000 level. If it goes through the 5,000 level, the next line of defense would be the 200-day moving average right here. And if it goes through the 5,000 level and the 200-day, then in my mind that's going to be a really ominous sign. But right now we're selling off, and there's a lot of uncertainty with the upcoming election. It's a very tight race, and I talked about a little bit about that last month. There's a really good video by Simpler Trading that's about the election. I sent a note about that on the Meetup page. So if you remember the Meetup group, you can go to the message board and you'll see the link to that video. Let's looking at the IBD 50, which is growth stocks. Looking at this on a weekly chart, one thing I noticed this week here is that this was some of the heaviest down volume on a weekly basis since February. Okay, and actually this week was a support week because it finished high up in the range. So this was the last down week in heavy volume, which was February. So nearly a year now, 10 months. So this is a pretty ominous sign here that we're seeing all this distribution in leading stocks. And the S&P 500 is also pulling back, and it is pulled back farther than the NASDAQ. You can see it's trading right at its 40-week moving average. And you can see it undercut this prior low right here, and it's hovering right at the 200-day moving average here. So this one already it lost support at the 2100 level, but it's still pretty close to it. So if the S&P comes down below the 200-day, the next spot we'll be looking for support would be the 2000 level. This is important because it's a whole number, first of all, that a lot of people are watching, and it also coincides with this prior low from the Brexit sell-off, the British exit vote sell-off. Okay, so that's the market wrap. We talked about pyramiding. Let's talk about, I'll just share some recent trades. It has not been a couple good weeks here, I'll tell you that. Weibo, this is a stock I've traded several times this year. So this stock, pattern recognition is not calling this a flat base, but in my mind it is, and I even made a note here that with the information. So I was watching this, and I drew this sloping trend line right here, and when it broke that trend line on this day, I made my B1 buy, so my 50% of a position I bought. And then the rest, I said I was going to wait till it went above this this prior price here, 51.82, which is just below the high, 52.29, which would be the standard buy point that IBD would call if they called this a flat base. So I made my B1 right here, and then B2 right here when this thing rose just above the this 51.82 level. And I was really happy on this day because this day was up in heavy volume, and then the stock started to pull back in lighter decreasing volume, and then it bounced back. So I was really liking this for a while. Then the stock started to, as the market has sold off, like you can see this black line here, as the market has started to sell off, the stock has started to decline with it. And so I was calling this, this was a first stage cup with handle here, and then this stock made a huge run, but this is really the first consolidation that was long enough to be called a base. So I call this a second stage base, and those are still high probability to work if the market's doing well. And the market's just dragging the stock down with it, and so I ended up having to sell this stock when it broke through. It broke through the 50-day moving average here, and it did that on a Friday. It broke through the 50-day moving average on that Friday, and it had closed just below the 10-week moving average you can see right here. But you can see volume for this week was not very high. So my thought was, okay, I really want to hold this stock. I chose this one to hold for longer term gains because the fundamentals are so fantastic. So I gave the stock till the following Monday to see what happened because it closed below the 10-week, but just barely, and weekly volume wasn't heavy. So this wasn't to me like a very ominous sign. And then that Monday, the stock did decline quite a bit, and I sold early in the day here because it was obvious it was going to be a down day in heavy volume. And you can see it finished nearly at the very bottom of the range in heavy daily volume. So I did get out of this stock over here at a loss. Another one is Paycom. I'm not holding any stocks right now, by the way. I'm not trading anything until after the election. So Paycom, this stock, I was calling this a flat base up in here. Let me draw this. So with this green line, I was calling this a flat base, and my pyramiding strategy for this stock, I had it on my watch list when it was, it got added to my watch list around here. So when it came back below here, it was kind of trading below the 50-day moving average, this red line. I said if it comes above the 50-day, that's my B1, and if it goes above this 51.46 level, that's my B2. So both of those things happened, and sometimes this happens even when you plan out pyramiding. Sometimes your multiple buy points will get triggered at virtually the same time, and that happened here. Early this trading day, I got triggered because it broke above the 50-day pretty decisively, and it went above this 51.46. So this day I ended up having to just buy the whole position all at once. And sometimes that'll happen, even when you plan out that you're going to pyramid into a stock, scale in. And you can see it really didn't do anything for the next week. It traded sideways mostly. I knew that the earnings report was coming up. I decided to give it a shot back here, and I thought, well, if it gives me a 5% profit cushion over the next week, I'll hang on to it through the earnings report. It didn't do that. I basically sold at a break even on this one, and you can see I was very glad that I did, because when after the earnings report, this stock got hammered, and I'm still watching it because it did find support at the 200 day, but this one this was a case of why you want to have a profit cushion if you're going to hold a stock through the earnings report, because I would have lost a lot of money here very quickly. And the last stock I want to talk about is Facebook. So Facebook, this stock has a tendency of forming bases and then moving up just a little bit and forming another base and moving up just a little bit. So this thing is right now on a base on base on base. There's like 6 of them, all considered part of a big first stage base, because the stock hasn't run up more than 20% in between any of these bases. But I bought this stock. This was on my watch list back in here, and there was an early buy point right here, this 126.09, that in hindsight I should have used this as my B1. I didn't. I don't remember if the stock was on my watch list at the time, actually. It may not have come on my watch list till after that. But anyways, this one I ended up just taking a full position on this day, and I didn't wait for it to go through the pivot, the 128.33, but I got in just a little bit below that. So this wasn't a great example of planning out a trade in advance. And if I remember right, it's because this stock wasn't on my watch list while it was basing through here. It was kind of later in the base. But anyways, this stock, you can see, basically just went sideways for several months that I held it, and I finally I sold this stock one of these days in here, because I knew the earnings report was coming up, and I was basically at break even. And you can see I was happy on this one too, just like Paycom, because this stock got hit pretty hard too. Not as hard as Paycom, but another example of why you definitely want to have a profit cushion if you're going to hold a stock through the earnings report. And you can decide what profit cushion is good for you. I use 5%. Some people use 10%. Some people will do an evaluation of the stock, of how it typically performs at earnings reports, and then make a decision. But in this case, Paycom and Facebook, neither one gave me a suitable profit cushion, so they both had to be sold. And it worked out, saved myself a lot of money doing that, even though the positions ended up basically break even. All right, so that concludes the market analysis and recent trades. So if you found this video on YouTube and you're not a member of the Meetup group, you can join by following the below link. You do need a free Meetup account, and it only takes a few minutes to set that up. And the reason you might consider doing this is because files like this presentation are only available to members. They're not. I don't put this PDF file on YouTube. It's only on the Meetup page. And if you're a member of the Meetup group, you get notified about when a new video is posted. And I also sometimes post things periodically throughout the month that you don't see them on the YouTube channel. You only get them if you're a member of the Meetup group. So if you're not a member of the Meetup group, I'd encourage you to join. It's free. It doesn't take long, and you won't get a lot. It's not like there's tons of emails coming at you from it either. I didn't get any. There were no questions last month from any members as far as the videos or the stock market or anything like that. So in conclusion, next month we'll cover the N in CanSlim. The N stands for something new. And if you have a suggestion for future topics or any other questions, just send me a message on Meetup, and I answer all the messages I get on Meetup. So I appreciate anybody uh, reaching out to me on Meetup, and if you have any questions, I look forward to hearing from you. So have a good month, and I'll be back at the end of November or early December.